Hello and welcome to IG's Trading the Markets podcast. I'm Victoria Scholar. The Federal Reserve has announced an aggressive 50 basis points rate cut on Tuesday. That's the first surprise monetary easing from the central bank since Lehman Brothers collapsed in 2008. Central banks around the world have been deliberating this week over how to respond to the threat of recession amid concerns about the coronavirus. Last week, global equities caught the bug, suffering their worst week since the financial crisis. Joining me on the podcast today is Justin McQueen, market analyst at Daily FX. Justin, thanks for coming on the podcast again. It was a real rollercoaster ride for markets last week, with the Dow ultimately closing down by nearly 3% after the Fed's cut. So why do you think the markets reacted so badly to the stimulus?
I think ultimately, with the case of the stimulus, a surprise 50 basis point rate cut from the Federal Reserve, it almost goes back to that sort of sign for the market is, well, do the Federal Reserve know something that, say, the market don't know? And so, of course, there's a bit of panic in that sense. And if you look back, like you mentioned, the last time we've seen a intermeeting cut was back at the Lehman Brothers. Are we really on that scale with regards to coronavirus and the effects that we saw at the back of the global financial crisis? Of course, we have seen some of the recent Chinese data, which have cratered pretty much for the month of February. So, of course, that's expected to knock off a bit of world GDP as we look ahead.
Yeah, so on the data, I mean, the Fed always says that it's data dependent and not kind of driven by the markets. But when we look at the fact that it decided to step in 2 weeks before its scheduled meeting to cut rates, to me, it felt like a bit of a panic response, really, to the fact that we did have that market sell-off. Do you agree?
I think firstly, with regards to, stating that they are data dependent, I think really you have to look back at the back end of Q4 2018. I mean, I think we had a 2-week period from when Powell stated that, well, we're at autopilot on the balance sheet. And then, of course, we saw that dramatic sell-off at Christmas Eve of 2018. And then, a week or two later, we've seen the Powell state that, well, we could potentially alter the balance sheet unwind. We could actually curtail that a lot sooner rather than later. So, of course, I think that was probably, for me, the first sort of signal that the stock market and also financial conditions do place a bit more weight than some of the data that we do see. And of course, I think last week's price action in equity markets and the response from the Federal Reserve pretty much just sort of seals that, really, that, of course, the stock market does play into their mandate, although they don't want to admit it. Of course, I believe it does. But at the same time, markets had been aggressively pricing in monetary easing. So in that sense, they probably did feel that their backs were against the corner. They actually did have to cut because, of course, they don't want to have unwarranted tightening of financial conditions.
Yeah, exactly. And some people were saying, if there wasn't a cut, that would almost be considered as tightening. But I mean, do you think that it's the Fed following the market rather than the market following the Fed?
I think, of course, with what we've seen was ultimately pretty much the markets forcing the Federal Reserve's hand, and ultimately they're just trying to get a bit ahead of the curve. But of course, that didn't really seem like enough for the markets, given the fact that we did see that initial upside, but then it was quickly faded with the Dow Jones obviously closing lower.
So given the market's reaction to the Fed's decision, do you think there's any kind of credibility issue within the Fed?
I think it's a funny question, actually, because I think, previously from what we've seen from the likes of Powell, I think really their credibility has been called into question for many years, and particularly in recent times anyway, with the likes of Donald Trump potentially trying to force the hand of the Federal Reserve. Of course, he did wager that trade war with China, ultimately forcing the Federal Reserve cutting 3 times last year and starting to increase the balance sheet. But again, so there will be, of course, a lot of talk about the Federal Reserve credibility. But that's always been a sort of a conversation.
So in terms of other central banks, we've heard from the RBA in Australia, that's cut rates to a record low this week. The Bank of Japan pledging support as well. There's been talk in the markets about potential loosening from the Bank of England and the ECB as well. I mean, if all the central banks around the world, the major ones at least, are all loosening at the same time, it means that those interest rate differentials aren't necessarily going to change. And a lot of economies aren't going to get that benefit from their currency depreciation if a lot of central banks are all acting in the same direction. So I guess my question really is, how effective do you think monetary policy can be when we're facing such a global issue?
Yeah, I think that's a good question. I think ultimately it's a case of, can monetary policy really be used in a way that could sort of support economies in light of the current coronavirus. I mean, yes, we have seen recent housing market data. We saw an increase in the MBA mortgage applications up by 15.1%. This was before the Federal Reserve actually cut rates. But, can you really argue that monetary policy is going to help support the economy, despite the fact that most economies are, particularly China, is in pretty much a standstill on the back of the coronavirus outbreak?
Yeah, and I mean, I guess there are questions as well about the effectiveness more broadly about monetary policy. I mean, when we think back to the financial crisis, that was an issue that stemmed from the banking sector. There were all these mortgages that had been repackaged, and it led to tightening credit conditions, and the banks weren't lending to each other. So it seemed like a natural progression to have looser monetary policy. When we're talking about the coronavirus, I mean, do you really think that it can be effective in staving off some of those concerns around a recession, for example?
I think ultimately, when we do look at, say, the equity markets, of course, it's not really going to be finding any support on its own without any fresh good news. So, of course, a lot more talk of easing monetary conditions, trying to provide extra liquidity. I mean, we saw the Bank of Japan continue to purchase ETFs on Monday. It was a record amount of ETFs being purchased. Of course, we've heard from the ECB. They're going to be looking at loosening credit conditions from some of the small businesses and medium-sized businesses. So I think really when it comes to monetary policy, the conventional ways anyway, there's limited policy space. We know this. We're already in negative in Europe. We've already seen Australia. They've cut now to 0.5%. They've only got one more cut before they have to start looking at potential quantitative easing in Australia. So I think they're going to have to be looking at other ways ultimately to try and support the economy and growth.
Yeah, back to some of those unorthodox measures again. But I mean, are you concerned about a global recession? Do you think that is realistically on the horizon?
I mean, I think if it was to be a global recession on the back of coronavirus, probably not. I think if we look back to SARS, now I know there's obviously not a direct comparison between coronavirus and SARS, but previously, back during that time, we saw the likes of the DAX that saw a max drawdown of about 20 to 25%. And of course, we saw in the S&P 500 that was down as much as about 12%. Now, of course, with equity markets, a lot of people prior to this had been stating that equities were pretty much at expensive, relatively lofty levels. So yes, we've seen a bit of a contraction, and maybe for a long-term investor, they might be thinking this might be a good opportunity to start going back into the stock market and go back up to those record highs. But we're not going to hit those record highs unless we get some support from central banks.
Right, and what about your outlook for the dollar? Because there were a lot of calls from analysts at the start of the year saying that this was the year that we were going to see a weakening greenback, and it didn't really happen straight away, although we have been starting to see that depreciation come through in the last few sessions. No doubt Mr. Trump is going to be pretty pleased about this. It's something that he's been wanting for a long time, along with looser monetary policy as well. I mean, what are you expecting in terms of your outlook for the US dollar? Are you expecting a further depreciation from here?
I think ultimately with the US dollar, if you compare it in terms of monetary policy, the Federal Reserve, of course, have more ammo at their, in their artillery in terms of interest rates than, say, the ECB, in terms of other major central banks as well. So, of course, over the past week, we have seen a fair bit of weakening in the US dollar. But keep in mind as well that with the Europe and the euro, which of course is a major counterpart of the dollar, that had been supported on the back of some of those risk-off flows, given the fact that the euro had been one of the favoured funding currencies. Now, of course, with the favoured sort of carry trades in terms of the Mexican peso, South African rand, we saw a massive unwind in that, and ultimately that did support the euro. So if the euro continues to pick up on the back of some of these sort of risk-off flows on an unwind of carry trades, and also given the fact that markets were very short the euro, so, of course, if we see an unwind of that, then that could help support the euro, which we have seen, and, of course, weigh down on the US dollar. But it's not only that in terms of the coronavirus for the US dollar. You have got the US elections as well.
Yeah, I wanted to ask you about the US elections because we've been seeing quite a bit of positivity come through in the middle of the week on markets. Part of that being attributed to the fact that Joe Biden is faring better than expected in the US Democratic leadership race, challenging Donald Trump and marching ahead of left-wing candidate Bernie Sanders. How much of the positivity that's coming through in markets do you think is actually because of the politics rather than the Fed?
I mean, I think in terms of that, it's probably hard to say really, how much is it impacting or not. I mean, I know a lot of people in the sort of forefront of investors' mind, of course, is on the coronavirus, and it's continued to spread. I mean, we've seen the likes of Italy closing schools and potentially going even further than that, and also Japan's Olympics. Sort of hopes at the moment might start to dwindle if that continues. But in terms of the US election race, with Biden starting to gain ground against Sanders and actually ahead of Sanders in the betting markets, ultimately that does provide equity markets with a little bit of relief, given the fact that Bernie Sanders had been somewhat of this person to be portrayed as somewhat very much anti-Wall Street. And so, of course, that sort of risk starts to recede. Then, of course, you do see equity markets find a little bit of support.
All right, that's all we have time for today. Thank you so much to my guest, Justin McQueen, market analyst at Daily FX. I'm Victoria Scholar, and thanks so much for listening to our podcast, IG's Trading the Markets.